So I thought I'd talk a little bit today about the craziness that we have going on in the financial markets, and I don't know. I guess the reason why people kind of regard this stuff as being kind of dirty. So we're gonna start with this article from The Hill. Banking executives sold millions in stock before crash. This is coming out of the Wall Street Journal, but The Hill is picking up the reporting. So let's get into it. Executives at First Republic Bank sold company stock worth millions of dollars in the months before this week's crash, according to the Wall Street Journal. The banking executive sold $11.8 million worth of stock in the company over the last 2 months, with First Republic Executive Chairman James Herbert II selling $4.5 million worth of his shares since the start of 2023, per the journal. Combined, the First Republic's chief credit officer, president of private wealth management, and chief executive sold $7 million worth of company stock. First Republic's insider sales appear to have gone largely unnoticed, as it is now the only S&P 500 company that reports such sales to the FDIC instead of the Securities and Exchange Commission. Signature Bank, which collapsed on Sunday, was also exempted from filing with the SEC. Anyhow, let's talk a little bit about this crazy stuff. So, the gist of the story is that in the months preceding the collapse of First Republic, its executives, its chief officers, they decided they were going to start selling company stock, which they had obviously invested in. Which is, if you ask me, sounds a bit fishy. If they knew that this bank was going to collapse, then obviously it's dirty as hell. But if this is just part of normal market trading stuff, then it's fine. But I mean, what are the odds that these guys didn't know that they were taking on massive amounts of risk, that they weren't paying attention to inflation reports and weren't thinking to themselves, maybe it's time to start selling off some stock because our own bank's positions are kind of, well, we can say, exposed. But then there's also the issue relating to why don't they just shore up their own investments in the bank itself? Why not, actually improve the company so that it's safe in the event of such a collapse? I don't know, but now that First Republic is now that the stock is essentially plummeted, maybe someone else can buy those shares on the cheap. I don't know. That's speculation. You can't really say whether that's true or not, but oh boy, does it seem kind of corrupt if you ask me. But don't worry, because apparently First Republic is going to get bailed out by other large banks. $30 billion to help First Republic survive this stuff. And so you have, was it Bank of America, Citigroup, J.P. Morgan Chase, and Wells Fargo they're each depositing $5 billion into the bank. Goldman Sachs and Morgan Stanley, they're going to be doing $2.5 billion each. So I guess it doesn't really matter for First Republic, because if the government doesn't come to bail you out, then large institutional legacy banks will come in to save you anyway, right? That's essentially what we kind of are looking at here. And while it's like kind of crazy that these large banks would choose to dump money into a bank that is having a lot of financial trouble, I think it does also point to the fact that these larger institutions could be worried about like trying to stem the bleeding or stop whatever financial ripple effect that could come. Like, it's necessary for them to prop up this bank before, ish hits the fan. But let's keep going, because I got more stories and they don't really get any better. So, Credit Suisse shares slide 10% as the shine of its rescue package wears off. So, in case you didn't know, Credit Suisse had received $54 billion as a lifeline from the Central Bank of Switzerland. I think it's called the Swiss Bank, pretty sure. Anyhow, it's basically they got 50 billion Swiss francs, which comes out to about $54 billion, 53.7 billion if you want to be extremely exact. But yeah, in a statement early Thursday, CEO Ulrich Korner said he had taken decisive action to strengthen the bank as it's continue. All right, we got some errors in typing here, but to strengthen the bank as it continues to implement a major overhaul announced last fall. My team and I are resolved to move forward rapidly to deliver a simpler and more focused bank built around client needs. Credit Suisse's share soared 32% at the open, but erased some of those gains to close up 19. Ah, man, words are failing me right now. Customers withdrew 123 billion Swiss francs from Credit Suisse in 2022, mostly in the fourth quarter, and the bank reported in February that an annual net loss of nearly 7.3 billion Swiss francs, its biggest since the global financial crisis in 2008. So yeah, All these banks are having liquidity problems, and so they're essentially having to move money around. Like central banks are trying to bail these things out, and yeah, it all just seems kind of dangerous to me because here's the risk. If central banks don't pump more money into these other banks that might fail, like Credit Suisse, that'll essentially just blow up the entire financial market, which I don't think anyone's keen to see that kind of thing happen. No one really wants to invite a second Great Depression upon the world, but if you bail these banks out, then doesn't that just increase inflation even more? So I mean, I don't know, man. I'm not the best person at financials. I think I know a few things, but it seems to me that this it's banks are essentially stuck between a rock and a hard place. Do governments and central banks, or central banks are basically government banks, so do governments and central banks essentially bail out these private banks, which are large and essentially are the biggest institutions in the financial market? Because if they do, then you don't have a Great Depression or an economic collapse, I guess you can say, where all these treasury bills, all these investments, is suddenly all of a sudden turn worthless, and smaller companies are suddenly they are unable to employ their people. That's option one. Bail out the banks, or option one is don't bail out the banks, let it all burn and collapse. The economy goes down the toilet really fast. Option two is bail the banks out and you have runaway inflation over an extended period of time where you just keep trying to delay the inevitable. And I can't say that I necessarily know how to fix the problem other than everything that everyone's doing seems to be somehow wrong. I mean, I guess you could say that's a bit arrogant of me to say, considering I'm not someone who really knows how the financial markets work, but sitting here, that's kind of how it feels. But yeah, we'll just keep going through the stories because I got some more to talk about. Let's see. Oh yeah, Silicon Valley Bank's former parent company has filed for bankruptcy protection. SVB Financial Group, the company that owned the failed Silicon Valley Bank until the US government took it over last week, has filed for Chapter 11 bankruptcy protection. So, the US takes over Silicon Valley Bank, but its parent company is having to declare bankruptcy, which is just fabulous. It's fabulous for anyone who's It's sarcastically fabulous for anyone who's hoping that the world can continue to be fine tomorrow. Trading the company's stock has been halted since Thursday, and a bankruptcy was largely expected. Yeah, great. And then why did Silicon Valley Bank go bankrupt? Well, a lot of it is that they invested in these risky companies, these startups who were pursuing technology things. And, that's important. But when these things go bankrupt, you have to accept that they go bankrupt. You can't just keep dumping money into a problem. These are just essentially money pits. What is it, the sunk cost fallacy? You can't just keep throwing money at the problem. But then you also have the issue of Silicon Valley Bank had no official chief risk officer for 8 months. 8 months, they didn't have one. I don't know, man. That seems kind of crazy to me. Silicon Valley Bank, a lender that was a fixture in the venture capital space for decades, collapsed on Friday. The California Department of Financial Protection and Innovation closed SVB and named the FDIC as the receiver. The trouble started on Wednesday after SVB suddenly announced a plan to raise billions in capital to cover big losses, setting off a widespread panic among investors and tech founders they backed. Shares of the company fell around 60% in Thursday trading, another 20% in aftermarket trading, and were halted at the open on Friday. So yeah, that's basically just going over what's already happened. The fact that this company lacked a chief risk officer seems absolutely crazy. A risk officer typically anticipates and manages regulatory, operational, competitive, or other risks faced by a firm. SVB's risk chief officer reports directly to a risk committee, which includes chairpersons of SVB's board and all the board committees, in addition to the chief executive officer, according to filings from the company. The committee is responsible for hiring, evaluating, and terminating the CRO, and as of 2023 was made up of 7 members. There you go. And from the New York Times, no, wokeness did not cause Silicon Valley Bank's collapse. I only get to read so many of these articles for free, but, gotta at least try to get this headline in there from the New York Times. Blaming workplace diversity or environmentally and socially conscious investments for the firm's downfall signals a complete lack of understanding of how banks work, one expert said. So let's just call this what it is. The New York Times is covering for DEI and ESG credit scores. It's basically trying to say that, well, because Silicon Valley Bank was doing a good thing by investing in companies that had these high, these high social credit scores, essentially DEI, ESG, those kinds of things. Which, I mean, it makes absolutely no sense to me. What makes sense to me is that a company, a bank, should invest its money in projects or investments that are going to likely succeed and produce a reasonable return. Look, I'm not the most knowledgeable about how financials work, but here's what I do understand. If I'm going to invest my money, I want to fully understand what is happening with that money, and I want to understand how it is I'm going to get a payoff. I don't really care if a company hires a guy that is homosexual. Well, to a degree, I guess you could say that some people do care. But I think when you're dealing, if you're only concerned about results, then the chief result you should be looking for is this a sound investment? And these social credit scores just wind up pushing up the odds that other companies get investment based off of absolute garbage that does not pertain to whether or not they're actually going to be successful. Yeah, I had made a comment on this earlier. Basically, it's just they're criticizing conservative commentators and such as basically not understanding how it works, and I think they're the ones who don't understand how it works. So, a growing chorus of conservative pundits and politicians have said the failure of Silicon Valley Bank was the result of the bank's woke policies, blaming the California lenders' commitments to workplace diversity and environmentally and socially conscious investments. So it's basically social engineering or social programming. They're going along with current thing or whatever mainstream institutions say is good socially in order to get approval. Or they're using that to guide where they're putting their money, which is not sound. Because doing things that people like does not mean that those things that are going to generate a return on investment. These claims are without merit. The bank's collapse was due to financial missteps in a bank run. Bullshit. I'm going to call bullshit on that. Moreover, the firm's policy on diversity, equity, inclusion, also known as DEI, is similar to ones that have been broadly adopted in the banking sector. Yeah, it's being broadly adopted because there's a cult-like mentality in people who control mainstream institutions. Yeah, that's essentially what it is. It is a cult that is influencing these arbitrary things. I mean, look, just to play devil's advocate, I could start a completely Christian credit score for how well your company adheres to Christian doctrine, and any lapse in there, and I can say, well, maybe you shouldn't get financial investment when that absolutely does not pertain to whether or not any of your investments are actually going to pay off. That's all it is. It is pushing. It's just pushing a social agenda. Social agenda. Now, whether or not you approve of that social agenda is a separate matter entirely. Some people may very well like this. They may very well like that you have a bank that is essentially investing in companies that push a social agenda. Other people would probably like a bank that would push a right-wing social agenda. And what I want to point out is that ultimately, when you're making investments with your money, your chief concern should be, am I going to get a return on that investment? And if you want to make the choice to say, well, I'm going to make sure that I get a return on my investment and also support the causes I want to support, I suppose that's perfectly sound as well. The problem, though, is when you lose sight of the bigger picture and you blow up the financial sector, it leads to a chain reaction that keeps getting out of control, where central banks keep having to try to bail things out, or other banks are trying to bail smaller banks out. It's eventually going to... I'm worried it's going to hit everywhere. I don't want it to, but it might. Moving on. While Silicon Valley Bank collapsed, top executive pushed woke programs from the New York Post. A head of risk management at Silicon Valley Bank spent considerable time spearheading multiple woke LGBTQ plus programs, including a safe space for coming out stories as the firm raced toward collapse. Jay Ursapa, the boss of financial risk management at SVB's UK branch, launched initiatives such as the company's first month-long Pride campaign and a new blog emphasizing mental health awareness for LGBTQ plus youth, which doesn't make sense because why the hell would a bank be employing youth, and why are you doing health awareness for these people. The phrase, "you can't be what you can't see," resonates with me. Ursapa was quoted as saying it on the company website. As a queer person of color and a first generation immigrant from a working class background, there were not many role models for me to see growing up. Do you need me to explain to you why it is that there aren't very many role models in the LGBTQ plus community for the human civilization writ large? It's because LGBTQ plus people don't produce new humans. Heterosexual people do, or I should say, people who are, yeah, heterosexual people are more geared towards producing new humans, and that's how the species continues. The LGBTQ stuff thing doesn't generate new humans. That's just reality, no matter which way you want to cut it. But meanwhile, this guy's deciding that he's going similar to the. It's similar in an ironic sense. His orientation, you can say, doesn't promote the continuance of the human species. In the same way, his orientation is also. It's not his orientation, it's his ideological philosophy. It does not continue the advance of acquiring money or stabilizing the economy. In fact, it seems to have directly put it at risk because we can see where his focus was. The focus was being on LGBT. The focus was on these minority groups, not on making sound investments that don't blow up the economy for everyone, LGBTQ plus and others. I mean, it feels like it's a basic thing to point out, but apparently it's, according to the New York Times, that's just what conservatives want to point out because they're racist or misogynistic or homophobic or any other kind of category you can try and fit them into, rather than just admitting that the arguments have a point. Moving on. Will Americans end up footing the bill for bank failures? Probably, in one form or another. I mean, at the end of the day, even if the government doesn't wind up taking taxpayer money to bail out these banks from their problems, it's still, if the government does take taxpayer money, we're going to get inflation, which you get to foot the bill in another way. If the government doesn't do it, then the financial sector might implode and just collapse, and then you pay for it in another way. So the moral of the story is the little guy gets screwed, unfortunately. I don't know any other way other than to put it that way. What does the Silicon Valley bank collapse mean for the economy? From 538. Well, it means a lot of problems. I'm surprised they didn't write something about what it means for politics in the 2024 election, because I think that'd be a little bit more significant, considering 538 should be dedicated towards, I don't know, election forecasting, particularly presidential election forecasting. That kind of makes sense to me. On Sunday, the Biden administration said that SVB and Signature Bank customers will be made whole, even if their accounts exceed the $250K. That is covered under the federal law. But there's a lot of uncertainty about how SVB's collapse could affect the rest of the economy, and also how the government's intervention will be received by the public. The Biden admin has underscored that this isn't a bailout, but it's not clear if that's how Americans will see it. Yeah, it's not a bailout, because a bailout would mean that the U.S. government essentially steps into the bank and starts pumping money, taxpayer money, into the bank in order to save it. I believe what they're doing is something called a bail-in, where essentially the government seizes control of the bank's assets and then gets to make decisions about how those assets are allocated in order to make sure that people suffer the minimum amount of harm and keep the thing limping along. And good luck with that. SVB, but the bank itself couldn't figure out how to do that, so what makes you think that the government will be able to? At least the people who worked at the bank have some ideas of what the bank's financials are. You're going to have to bring everyone from the government up to speed as to what the hell is happening, and then hope that the people of the government can somehow squeak out a solution, which seems kind of, I don't know, hard to believe, if you ask me. Moving on. This one kind of made me funny. From Business Insider, Russia is so cut off from the international financial system that the Kremlin thinks Western sanctions have insured the country against the banking crisis. You know what? They're probably right. Probably right. Nice little picture of a smirking Putin over there. Putin's not exactly my favorite guy in the world, but I found this article kind of humorous because, it's It's not wrong. The Kremlin said Russia will not be impacted by the US bank crisis. Kremlin spokesperson said Russia is insured against the fallout from Silicon Valley's bank collapse. Sanctions over Ukraine war have cut Russia off from the international financial system. So I think there is. I'm going to read a little bit of the article, but then I'm going to give my thoughts as to how Russia could still be a little bit exposed. All right, it's been a rocky week for US banks, but the Kremlin's looking at the bright side of things. Russia is now so cut off from the global financial system that the Kremlin thinks it will face no impact from the collapse of Silicon Valley Bank. Our banking system has certain connections with some segments of the international financial system, but is mostly under illegal restrictions from the collective West. The spokesperson for Kremlin, Dmitry Peskov, said Thursday, according to TASS state news agency. He was referring to sanctions against the country over its invasion of Ukraine 1 year ago. We are, to a certain extent, insured against the negative impact of the crisis that is now unfolding overseas. Russia's economy is stable and stands firmly on its feet. In contrast, Russia, like much of the world, faced a credit crunch due to the fallout of the U.S. subprime mortgage crisis in 2008, which ultimately led to the global financial crisis. As the country recovered from the recession, it started working towards its grand ambition of making Moscow a global financial hub, but that dream has now been bruised with Russia under sweeping sanctions. All right. Now I'm going to talk a little bit about how I think Russia could still be kind of exposed, and that's going to be through China. Russia has been linking up its economy with the BRIC system and with China itself, mostly with China, I'd say. Russia is selling oil to China. Russian and Chinese banks have been collaborating. That's how Russia's been able to keep itself afloat in the meantime. Now, there is a significant problem, though. China owns a significant amount of U.S. debts, or of U.S. government debt specifically. If the U.S. economy blows up, if the dollar is essentially rendered worthless, which could happen, I'm not saying it will happen, but maybe it will, then essentially that debt in China is worthless, which could cause a similar series of financial problems within China itself. And if the U.S. debt that China holds becomes worthless and China starts going down the toilet of financial problems, then Russia would be next on the list. And that's how Russia is exposed, through China. If I had to take a guess as to how Russia might be exposed, that would be it. Maybe not. Maybe, I don't know. I'm not really a financial person. That's just my guess. Meanwhile, the bond market is going absolutely bonkers. The volatility making it hard to say what stocks are worth as banking jitters persist. So yeah, basically, because inflation has been so high, T-bills are no longer worth anything because the rate of inflation is higher than the rate of return on the T-bill. Which, to suffice it to say, that you buy a treasury bond or a T-bill, and after a certain amount of time, you get your money back with interest. That's how it works. You're essentially loaning the government money, and you get to collect a little bit of interest on that. And it's historically regarded as a fairly safe investment. For those of you who don't know how this stuff works, I know a little bit, so I can kind of try to explain it in maybe less than perfect terms, but this is how I understand it. So let's say you get 10% return on your treasury bill. But let's say the inflation is at 15%. Well, you lose out on that treasury bill because inflation is beating your treasury bill by 5%. Goods are going to be about 5% more expensive. So you may have gotten 10% back on the money you invested a while ago, but that is irrelevant because the inflation has ruined the value of things. So you might as well be dealing with 5% inflation and make it still be safe to try and preserve wealth. But people are looking to make wealth. That's how these markets work. Oh yeah, we got this article from Forbes. I thought this was kind of cool. List of banks from 2000 to 2003, the ones that failed anyway. So for scrolling down, 2002, 411, we go down to 2008, 25 banks fail. 2009, 140. 2010, 157. 2011, 92. 2012, 51. 2013, 24. 2014, 18. And it drops back into single digits. And then by 2018, 0. 2019, 4. 2020, 4. 21, 0. 22, 0. 2023, back up to 2. So when you look at it this way, things feel fine. But this is a very particular perspective. When you think about how this thing keeps spiraling out of control, it feels a lot less secure. And then we have a couple more articles. Don't worry, we talk about that one. It's a big failure for us from Fortune.com. Sweden's largest pension fund invested in both Silicon Valley Bank and Signature Bank before they failed. So, yeah, Swedish pension funds are basically going to be having a lot of trouble because they invested in these banks that have failed. So that's not exactly comforting. Credit, so yeah, I already talked about this Credit Suisse. It's the lifeline that I got. Silvergate Bank. It was a cryptocurrency focused one. Announced it would cease operations and liquidate its assets after a bank run forced a California lender to sell a chunk of its debt securities from, I think, the New York Times. So, yeah, that brings me to the end of my articles I wanted to mention, but suffice to say, the financial sector is in shambles. Things are crazy. Stocks are going up and down each day. I have some stocks. It's kind of hard to predict where it's going to go. Thinking about selling those things, but that's me. I don't pretend to give anyone financial advice. I don't know what the right thing to do in this context is. What I can say is things are feeling scary. I'm a little scared. I won't tell anyone else what to do, but I'm thinking about what I should do. I know people around me are thinking about what they should do. I will say that if there is a giant financial collapse, and if I was smart enough to get my money out of the way before that collapse hit, I would be looking around to buy stocks on the cheap. I mean, look at the biggest companies that you know are probably not going to fail, and then I would buy those stocks, hoping to make a huge return on that investment. But then again, that's me. That's what I would do. Not a financial advisor. I don't really know what the right thing to do is. But yeah, stay safe out there, guys, and pay attention to the news. World's getting crazy. Hopefully, it doesn't get any crazier. Thanks, and bye.